AI. So over the past 3 years, the US stock market has been on a wild ride. And at the heart of it, AI. And honestly, AI has already changed my life. It's changed the way I search for information, the way I work, and even how I apologize to my girlfriend. Oh wait, that's a little too much information. But anyway, while AI feels magical on the surface, there's a growing number of skeptical voices warning that we might be in the early stage of something far more cynical, a stock market bubble. So in this video, I want to break it down. The bull, the bear, and where I stand today with this entire AI bubble story. And I'm sure I'm not alone here, especially if your social media algo is tuned to financial media like mine. So you have probably seen those viral infographics like these, comparing today's AI-led rally to past market manias, the dot-com boom, the crypto craze, and even all the way till the Nifty 50 era of the 1960s. And when viewed through a historical lens, it's hard to ignore the similarities. After all, this AI rally has been fast, furious, and violent. Valuations skyrocketed, expectations are soaring, and if you were to zoom in, many companies still haven't turned their AI ambitions into meaningful earnings. So take the most iconic name in this new AI era, ChatGPT, the parent company, OpenAI. So while OpenAI might be private, third-party estimates suggest that despite having around 10 million paying subscribers to its suite of subscription products, the company is still burning cash. And the projected number for 2024, roughly 3.7 billion in top-line revenue, but around 5 billion in losses, mostly due to the immense cost of running and scaling its advanced AI models. And that imbalance has already triggered talk of restructuring and renewed fundraising. And while we are all trying to figure out whether this whole AI boom is the real deal or just a bubble waiting to pop, why not actually put the AI to work for you without paying a single cent? So this video is sponsored by Longbridge, a MAS licensed broker in Singapore that's integrated a really powerful tool called Pod AI, built specifically for investors. So Pod AI helps you break down company announcements, summarize financial reports, and even lets you chat with it to dive deeper into any stock, from key metrics to valuation insights. So it's like having a research analyst, but way faster and available 24/7. And right now, Longbridge is running an exclusive promotion for new users in Singapore. You'll get lifetime commission-free trading for US, Hong Kong, and Singapore stocks. And if you deposit just 2,000 Singapore dollars, you'll receive a 0 platform fee coupon and a 6% per annum interest boost for 90 days. Even better, at the base tier, if you maintain your funds for 30 days and complete 3 buy trades, you'll be rewarded with half an Nvidia share. And the best part, if you sign up using my link below and deposit that same initial sum of 2,000 Singapore dollars, you'll unlock an exclusive $18 cash coupon plus an additional 6% per annum interest boost. And this brings the total to a 12% per annum interest boost for 90 days. So altogether, you could be looking at up to $160 in sign-up rewards just for getting started. So check out the full details in the description below, and thank you Longbridge for sponsoring this video. So OpenAI isn't alone. Across the board, we are actually seeing a surge of capital, ambition, and hype. But the profits, not so much. At least not yet. So let's zoom out a little. Because like every other major revolution, AI has its true believers and its fair share of skeptics. From railroads to electricity to the internet. Each went through a speculative phase before delivering real shareholder value. And now, many believe AI is the next platform shift, as big as the internet, maybe even bigger. But history also reminds us that hype tends to get ahead of fundamentals. During the dot-com bust, most internet stocks actually crashed 90% easily. And to be frank, I didn't pay much attention to this whole quote-unquote AI bubble debate in the first place. So coming out of the 2022 bear market, valuations still felt relatively grounded, and many of the companies leading this AI rally, especially names like Nvidia, were actually delivering. So we saw strong revenue growth, expanding margins, and solid earnings to back all of these rally up. And I remember people comparing Nvidia's crazy run up to Cisco during the dot-com era. And the implication, this too shall pop. But honestly, that just felt lazy. Nvidia isn't just some speculative story stock. They've got earnings, massive demand, they're shipping real stuff and pulling in real cash. So just because the stock moves fast doesn't mean we are in bubble territory. At least not yet. And fortunately or unfortunately, that's just Nvidia that we're talking about today. What's more worrying is the broader trend. Suddenly, everyone wants to be an AI company. And you have probably noticed it too. Many firms are starting to slap the idea of being AI powered onto their pitch decks, rebranding overnight, and riding the wave. In fact, just recently, over 50% of the S&P 500 companies now mention AI in their earnings call, and that alone would raise a few eyebrows. So when every company is trying to catch the AI tailwind, regardless of actual integration or product relevance, it starts to feel more like a marketing strategy than a technological one. And that's where my perspective started to shift a little. And recently, a comment from Joseph Tsai, the chairman of Alibaba Group, and someone that I follow pretty closely, rang some alarm bells. So in a speech at HSBC's Investment Summit, Joe actually warned that the AI infrastructure boom might be getting out of hand. And he noted that big tech firms and private funds are racing to build massive data centers across the US and Asia, many without clear customers in mind. And I quote, "I start to see the beginning of some kind of bubble. People are raising billions to build data centers on spec, and that gets me worried," unquote. So Joe also pointed to the staggering sums being thrown around in the US. So this year alone, Amazon, Alphabet, and Meta have pledged to spend 100 billion, 75 billion, and 65 billion respectively on AI infrastructure. And in his words, people are literally talking about $500 billion or more, and I don't think that's entirely necessary. It feels like we're investing far ahead of actual demand, unquote. On the flip side, we have someone like Eric Schmidt, the former CEO of Google, who recently spoke at a TED Talk and argued the exact opposite. This current AI revolution is underhyped. And yes, I repeat, it's underhyped. So in his view, we are all underestimating just how transformational this technology will be, not just for productivity or business, but for society as a whole. Here's what he had to say.
You actually think AI is underhyped. Why is that?
And I'll tell you why. Most of you think of AI as, I'll just use the general term as ChatGPT. For most of you, ChatGPT was the moment where you said, oh my God, this thing writes, and it makes mistakes, but it's so brilliantly verbal. This was 2 years ago. Since then, the gains in what is called reinforcement learning, which is what AlphaGo helped invent and so forth, allow us to do planning. And a good example is look at OpenAI O3 or DeepSeek R1, and you can see how it goes forward and back, forward and back, forward and back. It's extraordinary. So you're seeing the arrival, the shift from language to language, then you had language to sequence, which is how biology is done. Now you're doing essentially planning and strategy. The eventual state of this is the computer's running all business processes, right? So you have an agent to do this, 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 and you concatenate them together, and they speak language among each other.
And of course, as always, we have the astute crowd from YouTube immediately pointing out that the video should be retitled to AI Mega Investor Hypes AI. I mean, fair point. At the end of the day, we all need to remember that everyone comes with their own agenda. Now, circling back to Eric's grand vision, where AI integrates into every layer of the business operations, the implications could be far more disruptive than most people realize. And we are already starting to see early signs of that shift. So across industries, companies are citing AI-driven productivity gains as a reason to trim headcount. So UPS, for example, announced the largest layoff in its 116-year history, attributing part of it to advancement in machine learning. BlackRock, on the other hand, the world's largest asset manager, also let go around 600 of their employees, with automation and AI playing a key role in that decision. And this might actually just be the beginning. So after hearing what the former Google CEO had to say, I think it's worth looking at what the current CEO, Sundar Pichai, is saying about the road ahead.
Anthropic CEO says AI could eliminate 50% of white-collar jobs in the next 5 years, unemployment rising to 10 to 20%. Do you agree?
Look, I think we should take those concerns super seriously, right? With this technology, to my earlier point about new jobs getting created, you're going to create new opportunities. I look at something like VO3 with video. It's clear to me you're going to allow pretty much everyone in the world to be a sophisticated creator. I can't sit and linearly, imagine what the impact of that will be, right? So you're creating all these new opportunities. You have tremendous positive externalities. There could be job displacement. I mean, those are serious concerns. So as a society, you have to think about how do you reskill people? What are new social safety nets that you would need? But I think being too specific and saying that many jobs will be, I just don't see we have made predictions like that for the last 20 years about technology and automation. It hasn't quite played out that way.
Yep.
The million-dollar question. How should investors like you and me make sense of this AI crossroad? One perspective that got me thinking came from Scott Galloway, a professor at NYU and a pretty successful 9-figure investor. And he asked a brutal question. Where is the actual value being captured in this AI boom?
I came to Orlando last night in an aircraft that skirted along the surface of the atmosphere at 8/10 the speed of sound. It has changed the world. I didn't have to get on a steamship like my parents for 14 days and get sick. Airlines have lost more money than they've made. PCs changed the world. Very few PC makers have made any money. There are a set of companies and technologies where the majority of the value accretes to stakeholders versus a small number of shareholders. Could DeepSeek signal that AI, and I think this would be a good thing, might be more like the airline and the PC industry than search or social, where in fact the winners are going to be the general public and no one or small number of companies is going to be able to capture all of the value.
And he's got a point. Just because something is transformative doesn't mean it will make money, at least not for everyone. While I don't necessarily agree with everything Scott has said, but I do see where he's coming from. So much like the aviation industry, not all parts of the AI ecosystem are created equal. And that's always been the law of the jungle. And this will distinguish between good investors from bad ones. And we've already seen certain segments of the AI value chain reaping outsized rewards. You have upstream players like ASML and TSMC on the manufacturing front, chip designers like Nvidia, and downstream tech platforms like Amazon and Meta. They have all benefited. And when you zoom into companies like Meta, whether it's on enhancing product experience or improving monetization engines, especially in the advertising business, these companies are clearly leveraging AI to drive real impacts. So yes, I buy into the idea that AI will fundamentally reshape how we live, work, and play over the next decade. And the smartest, most adaptable companies will figure out how to ride this wave. And this ties back to something Sundar recently said.
If I were to think about the unit economics of Google's business, there's a cost to serve a search query, and there's revenue per search. How is that number changing, or how will that change in this kind of evolution in search towards more of an AI interface? Because I've got to assume that to serve an AI-driven query is much more expensive.
Look, this is something I think people are really worried about 2 years ago, but I've always felt to the extent that something is about the cost of serving it, Google with its infrastructure, I'd wager on that, right? And on our chances to do that better than pretty much anyone else.
So focus on companies with a proven track record of execution, and the upside will take care of itself. Lastly, since we opened this entire discussion with the question of whether we are buying into an AI bubble, I thought it'd be fitting to end with a recent insight from Monish Pabrai. So he brought up an interesting case. Even if you had invested at the peak of the Nifty 50 bubble, your long-term returns would still have been respectable, provided you held the right businesses or companies or stocks in this case.
If we go back to the early 1970s, there was this concept of the Nifty 50. And basically the idea was you bought these 50 happening blue chip stocks, 2% into each one, and you didn't really care what the valuations were or anything. You just bought them all. Now, what happened in 73, 74 is that was a crash in slow motion. It was a pretty big market correction when you look at the peak of 73 to the bottom of 74. The Nifty 50 got taken out back and shot. It was a bloodbath. And by 1975, nobody would admit they were invested in the Nifty 50. Now, there's some controversy whether Walmart was part of that Nifty 50 or not. Just to make my case easier, we're going to assume Walmart was part of the Nifty 50. So let's say you invested in the Nifty 50, you put $100,000, 2,000 of the $100,000 went into Walmart, one of 50 bets. Now, let's also assume all the other 49 holdings go to zero. Now, there were some real losers in there like Xerox and Polaroid and Kodak and IBM, etc., which actually IBM didn't go to zero, but some of the other guys did go to zero. But there was also ADP and Coke and Amex and Disney and all of these companies in there. I'm taking everything to zero except Walmart. So you have $2,000 that you put in. If you kept it invested for the last 55 years, with 98% of the portfolio going to zero, your annualized returns are almost 15% a year. And you blew out the S&P 500 with a 98% error rate. Okay. Now, to do that, one is you needed to recognize that Walmart was a beautiful wife and no mistress was better than this beautiful wife. And you had to hang on to it.
So, are we in a bubble? Maybe, maybe not. Should that stop you from investing in great companies? Probably not. Because the truth is, it's not about timing the top or bottom. It's about owning the kind of businesses that can adapt, grow, and keep compounding over long periods of time through booms and bust cycles. Because ultimately, that's what drives shareholder returns, not market sentiments in the short term. So I hope that you enjoyed today's discussion, and I'll see you in the next video. But more importantly, and hopefully, I'll see you guys on the moon. Goodbye.